All right, welcome back, everybody. Today we're going to be talking about periodic inventory. Let's take it back real quick and talk about the original question, which is we are primarily focusing on merchandising inventory, which that means we are going to buy our goods, right? Buy them at a really low price. And our intentions to do with this inventory is to mark up the value and make a profit. So what we want to do is we want to make purchases of inventory. And our goal is to convert cash into goods. Okay, so meaning we make our purchase. And then we're going to take that goods and we're going to convert it into sales, right? To sell it to our customers. And ultimately, those sales will become cash. So oftentimes, most companies, right, that you often see them having a big warehouse. Okay, depending on what kind of company they are. If they are a really big company, they will typically have an extra warehouse with all the inventory items. Okay. So typical businesses that use inventory are obviously going to be retailers, not realtors, retailers, and wholesalers. Okay? You would often see them have manufacturing as well. Like, for example, anybody that produces the items, obviously they're going to have inventory, but most of their inventory per se is actually going to be like raw materials, things that produce and manufacture or create the item. So their inventory would be looking at a different type of inventory. However, our main focus is going to be merchandising inventory. So we're going to be focused as us either being the retailer or us being the wholesaler. Okay. So merchandising inventory, okay, which is pretty straightforward. It's they're going to be reported as actual cost of a product. Okay. So when we're talking about just having inventory, right? Every time you sell the inventory or every time you purchase inventory, right? We need to understand how much is it going to cost to get the inventory to our store. And that's the most important thing, because when we purchase something, right? There's a bunch of hidden fees or things that are tacked on to get those items to your store, right? If you go to, I don't know, a random store, right? Any store that you're intentionally to resell your product again, right? Let's say you go to a local like, say you go to Costco. Not only do you have to pay for the original price of it, you also have to pay tax on top of it. So there's a lot of things that you have to realize what is going to be included to get your assets or your inventory to your store. And those can include obviously the original price of the product, sales tax, freight expense, shipping and handling, even storage fees. Okay, so those are all included as part of the cost of your goods. Okay, when you sell them, you want to make sure that you sell them at a price that's able to cover all of these costs. Okay, so again, there are a few things that you can get away with, especially if you are buying from a wholesaler, right? You could be exempt from tax, but it also depends. I know that Costco, they no longer do that anymore. Even if you have a business license, they no longer offer tax exempt, as far as I know, in this region. Now, I don't know if in other states if they still do that or not. But yes, they used to do it, and it was great for businesses. But now that Costco is available to not only businesses, they're also available to the public, the general public. So anybody can be a member. So Yes, I believe you can just get discounts if you are an established business. All right, but other than that, those are a few things that you would typically see when it comes to you purchasing the actual inventory. If if it's getting shipped in, you would have to pay all of those things. Now, for the sake of this class, I'm only going to expose you to two things: freight expense, which is your typical shipping, and sales tax. Okay, now we'll look at a couple examples of us exposing to sales tax, and then some of them will not expose to sales tax. All right, so now understanding this concept is very important. I believe it's very important. Understanding what happens when goods are in transit. Who takes ownership and who owes what and who owns what. All right, because ultimately you say you purchase it, but you don't actually own it until it comes to your door. All right, here we explain exactly how the purchasing process works and what happens when your items are freight on board, which is what FOB stands for, and or if you do cash on delivery. What cash on delivery is, it's going to deliver to you, but you have to pay cash for the delivery. Straightforward. Now, understanding what the difference between FOB shipping point and FOB destination is pretty much ownership entitlement to the inventory or the asset that you purchase. Okay, so in this case, when we're looking at FOB shipping point, we're looking from the seller's store and all the way up to the midpoint, right? When it gets handed off to another agency or another facility or delivery, whatever it is, that's going to hand those items to the buyer. All right. Now understand this, that means ownership of the goods, right, is going to pass from buyer to the buyer yes, once it hits that midpoint. All right, but that means the buyer is going to be responsible for from the seller's store to the midpoint. The buyer is going to be responsible to pay for any cost, any shipping, anything that's gone wrong with it, because ultimately what this trade-off is I'm responsible to pay to get from the seller store to the midpoint. Okay? And then once it hits that midpoint and the ownership starts to transfer over, the midpoint to the buyer's store, the seller is responsible to pay for anything that happens to those items. Okay? So in other terms, it's like, I'll do you a favor to keep my stuff protected as long as it hits the midpoint. Then once we trade off, then you're responsible to make sure that my stuff is that comes to my store. So oftentimes an example of this kind of factor is going to be Amazon. Now, I have heard, yes, some stories about Amazon, how they no longer return or do the refund policy if someone steals your package. But however, under Amazon policies is they are solemnly responsible for your items to get to your door. And if it doesn't ever receive to your door, then there you can go ahead and be like, I never received my product. I paid for this and I paid my shipping. If you don't have Amazon Prime, I paid shipping. I paid for everything. Why is my item not to the door? So then what Amazon does is they take full responsibility for it and they either cover it, replace it, or they just give you your money back. Okay? So that's the only example I can, not only, but an example that I can describe to you that fits this concept 100%, right? Oftentimes, again, what is it? 100% customer satisfaction guaranteed, those kind of logos, right? Oftentimes, right, we've already paid to get from the seller store to the midpoint, and now it's the seller's responsibility to pay for, but also make sure that the items actually come to the buyer's store. Okay, Amazon. Think of it that way. Okay, a few key, few key terms. Few terms for a few key terms is going to be freight on board, which is FOB, and then other one is cash on delivery, COD. So again, I'm going to explain real briefly what COD means. It is pretty straightforward. If someone comes and delivers our package to you, you're going to either write a check or pay for that portion to get delivered to you. Now, you're not going to actually see this as often because nowadays everything is just going to be FOB shipping. It's going to be included into your bill. So this does exist in some areas, but not all places. Okay, but I do want you guys to know that it does exist and that it is still used. However, you're more commonly to see FOB, which is everything is going to be included onto the bill. Okay. All right. Any questions in regards to this whole tracking system? Now, I don't require you to know this in-depthly, but just to recognize what happens when you pay for the shipping and they also pay for the shipping. Okay. All right. All right, no questions?
Questions from my end.
Okay. All right. Now we can finally dive straight right into inventory tracking methods. Now, in this class, specifically just only this class, I'm going to teach you two different types of inventory tracking methods, okay? Periodic versus perpetual, okay? And for today's lesson, Chapter 5 and Chapter 6 is going to be focused mainly around periodic inventory, okay? Chapter 7 and Chapter 8 is going to be learning the second half of inventory, which is going to be mainly focused on perpetual inventory. Now, the difference is definitely going to be on how you measure, how you keep track of it, and it's also going to differ by what kind of costing method that you use. Now, again, we'll just take a standpoint, periodic and perpetual, right? So periodic, what happens is the definition of periodic means it's occasionally, right? Every once in a while. And this is true when it comes to inventory. It's where you're keeping track of your inventory every once in a while. All right? Meaning you're not gonna update it as often, and you're just going to you're only going to know how much you actually sell at the end of a given period, right? So oftentimes what periodic inventory does is you're just going to make a whole bunch of purchases, right? Purchase. You're going to have a whole bunch of inventory. You're going to have a count number, right? And then at the end of the day or at the end of the week, depending on how often you check your inventory, you're just going to go ahead and just count how much inventory you actually have on hand. And that's how you're going to determine how many items have been sold. All right? Now, that can be very dangerous if you don't have very high security, or, people like to steal things, or people like to take things from the actual warehouse. Yes, that is a possibility, but for most cases, or for the understanding of inventory, this is typically what would happen. And there are often times where real life, this does happen. You're always going to have to take a physical count of your inventory every so often, and that's going to reflect periodic inventory. All right. When you're dealing with perpetual is defined as constantly, right? Constantly or continuously. So what you're going to be understanding is you're going to be constantly updating inventory every minute, every second. And what that deals with, every time you make a purchase, you're going to update your inventory. Every time you make a sale, you're going to update your inventory, say that you don't have it anymore. All right. So at the end of the day, daily, weekly, whatever kind of period that you're at, you know how much inventory you have on hand at all times. All right. And so the key difference that I want you guys to get away from this is, one, periodic is every once in a while. You only do it every once in a while, and you need to have a physical count at the end of a given period. Whereas perpetual is going to be constantly updated throughout every single day, and depending on whether you make a purchase or a sale, it's automatically going to be updated, and you're gonna know how much you have at any given time, not at the end of the period. You should know how much you have at the end of any given period because you're constantly updating it. And the true difference that I'm going to tell you when you start journalizing it is, under periodic method, you're going to record your transaction as a expense. All right? You're going to record it as an expense. Whereas perpetual, you're going to record it straight into inventory. All right? So there's a difference here. One's an expense and one's an asset. All right? And we'll explain why it is necessary to do this, because again, at the end of the period, when you start physically counting how much inventory you have, you're going to need a conversion entry, which allows you to take the expenses and convert them into an asset. So in this case, periodic takes 2 steps to do, where perpetual inventory only takes 1. Okay. So again, our main focus is going to be on periodic inventory. Okay? Any questions in regards to that little brief segue right there?
Yeah, I have a question. So all businesses have both periodic and perpetual inventory. It's not like one versus the other.
Yes, they can have both, and we will look at that when we go into our fictitious business. Now, it is also dependent on what kind of item you actually have as well. If you are in the business of selling, I don't know, something that you would normally sell. Let's say use lids, okay? So they primarily sell baseball hats, right? Or baseball caps, whatever, right? That's their primary source, and usually they sell those a lot quicker than their t-shirts, right? Because t-shirts and stuff like that, you could get that anywhere, especially with like brands that you've seen before. Where lids, they have customizable options. You can have a specific hat, a specific color. So you are more likely to choose the hats as a perpetual inventory because you definitely want to keep track of it because it's your primary core of your business. Where you also sell clothing, but you can get the clothing anywhere. So periodic, you don't really need to keep track of the shirts because your store is called Lids. You're selling your hats. You're not selling shirts as often. So you would choose the shirts as periodic, something that you don't need to really keep track of often. Okay? So yes, a company can have both tracking methods, yes. Any other question? Okay. All right, so let's go ahead and dive into periodic inventory. Okay, so here we're going to just mainly focus on purchases. Okay, so when we're purchasing our inventory, so I have an example here on July 1st, XYZ company, right? They decided to purchase 100 units of toys, okay? So here, we're given a specific item, all right? Okay, from Toys U. Toys U. Okay, weird. Okay, from Toys U, costing $5.65 each. Okay, that's what it costs you to buy it. But when you sell it, you get to make that price point. Freight costs are the total of $100. Okay, purchase was made on account. Okay, so that means you're owing them. You're not writing them. You're not paying them right now. Okay, so how do you record this transaction? All right, so again, we're going to be looking at two accounts here. We're going to look at purchase expense, and we're going to learn about freight expense. Okay, now again, for the sake of this class, you can have more than just freight expense. You can have shipping costs, expedited costs. You could actually have a separate one for sales tax. Okay, you can have multiple accounts in regards to whatever types of shipments or whatever things that you need, such as shipping and handling. Right, that's completely different than actual freight. Right, you need to pay a little higher to make sure that your items don't break. So anything you're going to be looking at, for the sake of this class, we're just only going to focus on one aspect, which is just freight expense, okay? Just the shipping period. No handling, no extra cost to get the stuff to the door faster. We're just looking at regular freight, okay? And purchase expense. So these are the two accounts that we're going to be looking at. So how we're going to journalize it is obviously with the date. Okay, so same scenario. However, we're going to look at it in terms of dollar value, right? We got to look at it in terms of monetary measurement. So how are we supposed to journalize this? Okay, so the first one is going to be, we recognize that XYZ company made a purchase of 100 units of toys, okay? And it cost you $5.65 each. So what is the total purchases I am making right now? 565 is correct. And here we're also indicated that freight cost is a completely separate and it's $100. So when we journalize this, we're going to journalize our purchase expense and it's going to be for $565. Okay, because why? We just multiplied the number of units that we purchased them at and we multiplied it by the per unit rate, which gave us a total of $565. The next thing that we're going to do is we're going to record freight as a separate entity, separate account, whatever you want to call it. We need to separate freight, okay? And then lastly, because we've said we put it on account, we're going to add those two numbers up together and say that we place this on account. Okay, so that means we owe Toys U Company for a grand total of $665. However, we are recognizing that we owe them more than $565, right? We owe them for the full amount, okay? And you'll often see it on the bill. All right, so that is it for recording purchases. Any questions on that? Pretty straightforward, pretty easy.
No questions on my end.
Okay.
Lynn, one question.
Yes.
Now you debited purchase expenses and freight expenses,
Okay.
right? Why can't we directly debit the inventory?
Because we are focusing on periodic inventory. So if you remember, if I go back a slide here, when we journalize our periodic inventory, we are making an expense. Okay? In chapter 7 and 8, when we focus on perpetual inventory, that is where we're going to journalize them as an asset, as an actual inventory item.
Right.
Okay? All right. Any other questions in regards to why or how we journalize this?
Not from my end.
Okay. All right. So this one's straightforward. Just recognizing that when you're dealing with periodic inventory, you need to record them as an expense. Okay. And then when we reach the end of the period, once we do our count, which we'll talk about it tomorrow, that's when we recognize we need to convert it into actual inventory. Okay. So let me see if we're good on time. Okay. So, yes. So the next thing I want to show you is obviously if we're going to be making purchases, we have the ability to receive discounts. Okay? So what I wanted to be exposing to you guys is called terms. For those who were in QuickBooks class with me, you guys should know this for sure and are aware of this. But for those who are joining in with me now and never heard of them, what terms does is it gives you kind of like a discount period, or it gives you kind of like an incentive to basically pay on time. All right, and what either vendors or customers, I'm sorry, if you're the vendor, you can set up whatever discount you want. If you are purchasing from another vendor, then they can make up whatever rules they want to do. Now, what terms does is, again, it's an incentive for you to obtain a discount if you pay on time. And for this case, I gave you an example here where it's going to be 2%, 15, net 30. And that's exactly how you read it. 2%, 15, net 30. And what does that really mean? And broken down is if you pay within the first 15 days, you will receive a 2% discount. If not, you will pay in full in 30 days. Okay? So again, let's do that again. So if you pay within the first 15 days, you will receive a 2% discount. If not, you will have to pay in full in 30 days. Okay? Now, obviously, if you pay after the 30 days, you're gonna get hit with either, if the person charges interest, you will get hit with interest. If you pay after, you're gonna have a late fee. So yes. So these are kind of boundaries on when the bill is due, but it's also an incentive as well. You get rewarded if you pay earlier. And obviously with that, with businesses here nowadays, if you get to owe so much money, right? You want to have this incentive for people to pay you back, because essentially you need to get paid for the things that you sell in order for you to make more purchase of inventories to make more sales. So if you're not getting any money, then you're more likely your company's more likely to go really south. If you're letting everyone take all your inventory and not pay you back. Okay? So essentially that is what terms is. Okay? And then with this purchase discounts, okay, so you do have a couple choices when it comes to recording, all right? Now, if you think you are so good on paying your bills and you don't need an extra journal entry to tell you that you have made the discount and that you take it away, you're going to be using the net method. The net method means you're going to record the discount immediately. All right? So that's just you assuming that you're going to pay them on time. Now, for most small businesses, you can never predict whether you have enough funds or whether you make enough money to be able to pay a vendor back. Okay, so oftentimes if you're purchasing a lot of inventory, you can owe anywhere up to easily $1,000 to each vendor. Now, if you choose the gross method, meaning you decide not to take the discount right away, and you wait till when you actually have the money to pay the discount, then that's when you can go ahead and create your extra journal entry. So what the gross method does is you take the discount later, all right? And I'll show you exactly what I mean by all this, okay? So let's go ahead and look at the gross method at first, okay? So in this case, I have on February 1st, you purchase 100 coffee mugs on account from Cuppies Co. Okay, and it cost you $1.25 each, and freight was $100. Terms are 5%, 10, net 30. Okay, record this transaction as it occurs, and your assumption is that you're using the periodic inventory method. Okay, so here we're going to go ahead and journalize purchase expense, freight expense, and they're all going to be for their full value, right? Even though we do see that we have terms 5%, 10, net 30, we're going to go ahead and safely assume that we're not going to pay right away, and we have intentions to pay, but we cannot guarantee that we'll make the discount, right? We just have to play by ear and see how things go, right? So then here for scenario 1 on February 9th, so February 1st, okay? Make sure you keep in mind, February 1st. February 9th, you paid Cuppies Co. and I checked for the purchases that you've made, and terms of 5%, 10, net 30 are met, meaning you were in the discount period. So what's going to happen is when you record this transaction, you're going to record it as if like this. You're going to record your accounts payable, right? Because you recorded it as the full price amount, you're going to record it for $225. However, what you're going to do is you're going to create another account, okay? And this other account is going to be for purchase discounts, okay? And what you're going to do is, because you met the terms, you're going to take 5%. So 5% of the 200 and I should be very careful when I say that. When you take a discount, you never take a discount off the full amount. You can only discount the actual product, okay? So in this scenario, we only took a discount off the 125, okay? Freight can never be discounted. Tax can never be discounted. Anything that is not the actual product cannot be discounted, okay? Even if you have those false advertising saying, order now and you can get shipping for free. Okay, that one's okay. But in this case, you cannot take a discount off of any of those items, okay? So here we calculated what 5% of 125 is, and it's for $6.25. So therefore, when we write a check, we write the check for less amount, okay? Now, this is the gross method. This is when you choose to record it at regular price, and then you just so happen to pay on time, okay? Now, of course, let's say scenario 2 is going to be like, okay, what if you paid on the 15th of February, right? Now, if we look at our terms carefully, if in order to meet the discount period, you need to pay within the first 10 days. And we purchased it on the 1st of February. So that means by February 11th, that's it. You don't get the discount anymore. So in this case, I passed that discount period. So what's going to happen is you're just going to journalize it as is, as nothing happened, and you're just going to pay it for the full price. Straightforward, right? Common one you will see most often is most companies will use the gross method just because, again, the assumption is if you're constantly purchasing, and you're not receiving all your cash, all your sales in cash, unfortunately, you're not able to pay these people on time. And we'll take a look at that when we go into our fictitious company. All right. Let me introduce you to the net method now. This time, it's a different scenario, but it's going to use the same materials, right? So on February 1st, you purchase 100 coffee mugs on account from Cuppies Co., costing you $1.25. Freight is $100. Terms is 5%, 10, net 30. Record the transaction. So, because you're using the net method, your assumption is, oh, don't worry, I will definitely pay within the first 10 days. So what you're going to do is, I'm going to record my discount now. So I've already calculated the discount, right? I've already made the assumption that 100 times $1.25, which is my purchase price, right? And I'm going to go ahead and subtract the discount immediately. I'm going to go ahead and multiply by that 5% and subtract it out. So here, my discount is going to be for $118.75, and that means I only owe $218.75. Okay, because I think I'm going to be able to pay this without even talking about it. I can pay within the next day. Just assumption, okay? So let's say you do pay on February 9th. What's going to happen is you're going to recognize it, and you don't need to make an extra one. You don't need to make a purchase discounts, right? In this case, if we looked here, you've already discounted it out. You've already added it in without even, without having to create another account for it. All right? So in this case, I'm just going to pay for whatever amount it is. I don't need to make an adjustment. I just pay for the exact amount because I paid on time. Okay? No changes here. All right? Now what happens if I forgot and I end up paying on the 15th instead of the 9th? What's going to happen is you've already discounted the product when in reality you missed the discount period. So what you're going to do is you're going to have to create another account because you missed out on the discount period. So you're going to create an account called purchase discount loss. And what you're going to do is you're going to end up paying for the full price originally for the $225 instead of the $218. Okay? So that is the difference between gross and net method. Any questions in regards to the gross method and the net method?
No, ma'am.
Okay. So, again, oftentimes what you will see more commonly used will be the gross method because especially if you're owing a lot of money towards a specific particular inventory item, right? If you're a smaller business, you are more likely to use gross method. If you're a billion-dollar company, you're 100% most likely to use the gross method because you never know when you actually have the physical money to pay off your vendor to meet the discount period. All right. So that is all I have for section 5.1 and 5.2. So that's perfect. I'm going to go ahead and have you guys go ahead and take a break here. So again, I guess I'll go over the review. So we reviewed what inventory is, right? We're focusing on merchandising inventory, right? And we need to recognize that every single cost it takes for the asset to get to the store is going to be included. All right. We learned that there are two different tracking methods when it comes to tracking your inventory: periodic and perpetual. And for chapter 5 and 6's focus, we're only going to focus on on periodic. Oh my gosh. Periodic. All right. Understanding who has ownership when it comes to, or who is responsible for your shipment of items. Okay. And then understanding when you're looking at a periodic inventory, when you journalize your purchases, you're journalizing them as an expense. Okay. And then the next page is basically does the discount, understand what terms is. Okay. And also know that you cannot take a discount off of freight, tax, or any kind of things like that. You can only take a discount off the actual product price. And here are an example of what we just went over between the net and the gross method. Okay? Other than that, I would like for you guys to take a break. I think what I'm going to do is I'm going to go ahead and teach 5.3 right after. And then we can go ahead and dive into the exercises. Okay? All right.